Welcome back. Today it's April 6th, 2026, Easter Monday. The European markets are closed, but the US Institutional Volatility Terminal is lighting up with one of the most significant regime shifts we tracked since the Liberation Day tariff shock began. For weeks we have been locked in a full risk-off environment, but this morning the framework officially upgraded us to speculative. We're seeing a 4-point composite jump from -5 to -1 out of 9. But the real headline, the Dow Jones, just printed at 98% volume comp, a terminal record. In the entire history of IVT, we have never seen volatility coiled this tightly on a major US index. This isn't noise. This is a coiled viper at maximum tension. Today, we are breaking down exactly what that means, the setup cue with Bitcoin's near perfect signal, and why the next stability print could trigger the most explosive recovery trade of the year. If you're tired of reacting to headlines and want to trade with institutional grade discipline, stay with me. Context is everything. Let me pull up the regime delta log. On March 31st, we hit a cycle nadir composite at -8 out of 9. Total carnage across markets. Then came April 2nd, Liberation Day. The tariffs landed hard. The Dow dropped over 1,600 points in a single session, with the Nasdaq flushing nearly 6%. Retail sentiment collapsed. But while the headlines screamed recession, the IVT was signaling something very different under the surface. Extreme SD2L readings appeared even as price flushed. On April the 3rd, Good Friday market closed. Internal compression continued building quietly. Fast forward to this morning. The risk layer, layer 3, is officially on. Inter-market risk appetite is turning before price fully reflects it. We are now just 5 session and 8 composite points off the low. The direction has reversed. Now we're simply waiting for confirmation. Let's talk about this historic 98% volume comp on the Dow. For those new to the Cantillon framework, every percentage point of volume comp represents statistical volatility being stored, being compressed into an extremely tight price range. At 98%, that spring has pushed it to its absolute mechanical limit. This isn't isolated. The SPX sits at 97, Nasdaq at 91. When all 3 major US benchmarks coil simultaneously at these extremes, you're not looking at a quiet market. You're looking at a pent-up energy that will eventually release violently. At around the 45,000 mark, the data shows clearly institutional absorption of the Liberation Day flush. Big money stepped in while retail panicked. But here's the Cantillon discipline. We have a 0 out of 2 stability across all instruments. The move hasn't started yet. We do not front run a 98% compression. We wait for the stability print to reveal which direction the viper will strike. The volume compression doesn't show which way the move will go. It only shows that a directional move is about to be. So just a quick masterclass here, because understanding why these metrics matter in this exact environment gives you a real edge. Liberation Day tariffs created massive policy uncertainty. Markets hate uncertainty, so institutions didn't rush in aggressively. Instead, they hedged quietly, absorbing supply while volatility got artificially compressed into tight ranges. That's why we are seeing these record volume comp reading now. The SD2L extreme, our second derivative liquidity signal, flags when that hidden institutional position reaches extremes, often right before a regime flip. In post-shock environments like this, high volume comp plus SD2L signals has historically preceded the cleanest high conviction move because the weak hands have already been flushed out. Right now, the combination tells us the tariff-induced fear phase is maturing. Liquidity and risk appetite are quietly rebuilding. The only missing pieces is the stability goes to 1 out of 2. Confirmation that turns compression into directional momentum. This is why we don't chase price. We let the IVT tell us when the institutions are ready to move the market. Now let's move to the active triggers in the setup queue. We have the primary setup right now is Bitcoin, the current regime leader. BTC is trading at 69,744 with a confidence score of 5.3F. That 3F confirms the institutional accumulation across 4 timeframes. We've seen a solid recovery of the 64,500 floor, and the fear and greed index is still deep in extreme fear territory. Institutional buying into retail capitulation at the SD2L levels is one of the highest quality fingerprints the framework produces. When BTC prints stability of 1 out of 2, we are targeting the AVAP reclaim right now, and we have target 1 is 72.5, target 2 is around 75,000. The secondary setup is AMD. Currently, it is the strongest equity setup in the terminal. We have 84% coil with a clear bullish bias. Sitting right here, we had the SD2L extreme down at 188, and we have strong diversions in the IVT zone at around 192 to 200. Furthermore, we have reclaimed the AVAP on the 4-hour chart, and the pre-market is right now at 219.5. So this is a very, very good setup. The important thing is that AMD is a layer 2. It is equity. That is still off in the dashboard. So we do not buy it yet. We need S&P 500 to print stability 1 out of 2 first to activate that layer. Sequence matters in this framework. If you want to be long at the reclaim of the AVAP, you only go in with 25% of your normal positioning. Netflix is right now 90% coiled. It's the tightest single equity reading we have. Bias is currently bearish, around 2%, making this a high conviction inflection setup. It will move violently once triggered, but until we get stability confirmation, direction remains uncertain. We monitor closely, we don't trade blindly. And again, we need to see a reclaim of the AVAP. And right now, the AVAP is also falling, which is not the high conviction setup we are looking for. We do have strong deviation 3 times at the price around 93 to 96, which is very positive for Netflix price. But let's wait for reclaim of the AVAP, and let's see what the S&P will do while it is reclaiming the AVAP. Okay, so how do we actually play the next 24 to 48 hours? Here's your practical decision tree. BTC prints a stability of 1 out of 2 near the 69 to 70K area, while we are also reclaiming the AVAP with conviction. The risk layer signals fire already, and we have a green light to enter Bitcoin. Scenario B, the SPX prints stability 1 out of 2. The layer 2 re-engages. This cascades into equities like AMD that is already reclaimed the AVAP, and Netflix that is about to reclaim it. The scenario C is stability fails to print and the composite rolls over. The regime shift was a dead cat bounce, which means we stay flat. We do not fight the framework. So tomorrow, Tuesday, brings the first full liquidity session post-holiday. We have to watch the TLT closely. If it clears the 89, layer 1 liquidity could turn on, giving us the cleanest partial risk-on setup of the year. If not, we'll simply wait for confirmation And just remember that the war is still on, and Trump, he could basically make the market puke once more. But we have to be careful to look at that. The TLT pre-market is at 86 right now. So one final action item before we close. If you followed our March 31st brief, you caught the oil trade near $96. We hit both targets for a clean 16% winner. Today, the crude has reached an extreme VWAP deviation. The framework's edge is gone. So close the remaining position at today's open. Never let greed turn strong winners into a break-even trade. Pay yourself. The Liberation Day cycle is clearly shifting. Institutions are positioned. Compression is at record high. The only question left is, do you have the discipline to wait for the stability print instead of front-running it? If you want the real-time triggers delivered daily, including the new option signal generator that turns IVT readings into precise strike price and expiries, join the Elite Terminal. The link is in the description. I'm Jesper with Cantillon Research. Stay grounded, stay data-driven, and I'll see you in the terminal. See you. Safe trade. Bye-bye.